Hi, I'm Robert Greaves, and this is The Point. We're back with Paul Kitney, Chief Asia Strategist, Equity Strategist for Daiwa Capital Markets in Hong Kong. Thanks again for being with us. I want to get into something else. We just talked about the trade war, but I'd like to get into how Hong Kong and other specific economies in Asia are doing. So let's start with Hong Kong. And we've got a lot of demonstrations continuing, as you know. How is the economy faring these days?
Well, it's in recession.
Right now?
Right now.
Okay.
So we've seen the PMI collapse to below 40, which is indicative of quite depressed conditions. Obviously, inbound tourism from not only the mainland, but generically have slowed down dramatically. Retail spending has dropped significantly. The economy is hurting very much as a function of the protests and the domestic political problems.
So is this protest plus trade war, would you say?
Yes, absolutely. I think we need to look at all of Greater China, as well as Korea, as well as Japan, the North Asian trade-sensitive economies, in the context of the trade war, before anything else.
But let's parse this out a little bit. In the absence of the demonstrations, would Hong Kong still be hurting?
It would be hurting, yes. It would be hurting, yes. I think we're seeing a consumer discretionary shock in China, and so as a consequence, we would have seen a slowdown in tourism spend, but nothing in comparison to what we've seen.
Right. So the end of the demos would be much better for Hong Kong economically than anything else.
No question.
Okay. And what steps are the government taking, do you know, to defend themselves in this environment?
Well, I mean, I think there's been some fiscal stimulus, relatively small so far, some handouts and so on, but that's not really going to push the dial terribly far. I mean, that's to help the sort of immediate well-being, of Hong Kong people today, but how that's going to affect, the retail industry, the property sector, the tourism industry in general, is something that will require something more. Now, the interest rate cuts that we're seeing and the easy monetary policy in the United States, given the fact that the Hong Kong dollar is on a fixed exchange rate peg with the US, is helping. We're seeing fiscal stimulus in China, which indirectly should help, but it's not going to be able to offset the very location-specific or geography-specific problems that Hong Kong is facing.
Now, I'm going to bring up the peg, and we usually don't talk about politics, so I'm going to try to stay away from that. But if Hong Kong were to get off the peg, would that help or hurt its situation? Well,
I don't think that there's any real prospect of that happening, just to be upfront. But a freely floating exchange rate could, over the long run, help with economic adjustments. But over the short run, I'm not sure that it would help much at all.
And you just said it actually helped a little bit in this current instance, right? Having the Fed cutting has helped a little bit.
Yes, it has, and that's because of the fixed exchange rate.
Right. So let's talk about some of the other neighbors of Hong Kong. How is Japan doing? We've talked about China a little bit. I think we all understand that China's hurting, and it'd be great if the trade war were over for them as well. But how is Japan doing? How's Korea doing?
So Korea has gone to a current account deficit now for the first time since 2012. We're seeing a significant slowdown in the Japanese economy. The Japanese are just increasing their goods and services tax, which has come at an inopportune time. It's bad timing as far as where we are in the cycle for them. I understand the long-term considerations there. They're trying to improve or broaden the tax base in order to help some of their long-term fiscal problems. But from a macro stabilization perspective, this is not helpful near term. That economy is suffering. It's very much geared into the Chinese economy and global trade, as is Korea and Taiwan.
And as we look at ASEAN, are there any bright spots there, or how's Indonesia doing? How's Thailand doing?
So when we look at emerging ASEAN, so let's distinguish Singapore, which is part of ASEAN, but it's a developed economy, and emerging ASEAN. As we mentioned in the previous program, we're seeing production capacity shifts towards, in particular, Vietnam, which relative to the size of that economy is significant. And it's having an impact on FDI and growth. In fact, when we look at some of the market fundamentals, such as earnings growth and earnings revisions, we're seeing actually the best mix of earnings growth and revisions in Vietnam in the entire region. So earnings growth is accelerating from 2019 consensus base, 6% to 2020, 20% on positive revisions. Now that's in no small part due to production capacity shifts. When we look at Thailand, and I was recently in Thailand and I met with some government institutions there, and there is definitely a wake-up call as far as the FDI effect is concerned with respect to production capacity shifts and the benefits from that. Now, Thailand, unfortunately, on the other hand, is suffering from a strong exchange rate, which is undermining the net exports. So there's a bit of give and take there, which is which needs to be digested. But in general, we think that Thailand is okay. Indonesia is doing reasonably well. It's growing. Its inflation problems are now under control, particularly given that oil prices have moderated somewhat. And as a consequence, their current account balance has improved. It's one of the three twin deficit countries in the region. Philippines, Indonesia, and India have a fiscal deficit and also a current account deficit. So any improvement that we see in either one of those deficits, and we are seeing that, is good for Indonesia.
Let's go back to Singapore, which you touched on. How are they doing?
Well, they're suffering very much from the trade war. So GDP growth in Singapore is 88% correlated with global trade volumes, and global trade volumes have just had 3 consecutive months of year-on-year decline. So they're really suffering from that side. The domestic property market has not recovered from the measures that were imposed to moderate prices. There, in particular, sort of the stamp duty increase that occurred a while ago. So we're not seeing a recovery in the domestic property market as yet. So in general, the domestic demand really is not offsetting the weaker external demand. So that economy is not doing so well.
So if you look around the region, things are not very bright, is what you're saying in general.
No, they're not. I mean, there are bright spots. India is a bright spot. I think there's been a lot of talk about some of the risks in India. People talking about the problems in the non-bank financial corporations. But at the same time, and a slowdown in India, but a slowdown to 6%.
Not bad.
Not bad. I think there are a lot of economies that are dying for 6% growth.
Yes.
So we see growth in India being superior to anywhere in the region and possibly in the entire emerging market space because their demographic dividend is ahead of them. So their labor force participation rate is going to increase over the next 10 to 15 years. The demographic dividend for India is ahead of them, whereas the demographic dividend for China, for example, is behind them. They're an aging society. So their labor force participation rate is shrinking. So that's not going to be helpful for them. So relative growth we see in India is going to be superior than we see elsewhere in the world. So on a relative basis, pockets of emerging ASEAN and India, and I would highlight Vietnam in particular within emerging ASEAN, are really the bright spots.
But none of this is going to forestall, I gather, a recession at some point, a worldwide recession.
I'm not seeing a global recession because those two big emerging economies are going to power on irrespective. I don't see a technical recession in China or in India, for the next cycle. I do see the prospect of that in some parts of Asia, possibly in North Asia, but in those particular domestic demand-driven economies that are not geared into the global trade cycle as much, such as India, much of emerging ASEAN, Brazil. Yeah. Right. Really, I think will be relatively immune. It won't be completely immune but I see recession potentially occurring in pockets, but not a generic global recession.
So if you're an investor and you want to make some gains, you really have to find your country and your sector and what's going on, and you have to be very careful these days, don't you?
Absolutely. And so for me, and I've alluded to it already, is that gearing into or gearing away from global trade, which I see as the major risk, not just from the trade war, but as a function of the generic slowdown in the global economy,
right.
will manifest in lower demand for tradable goods. Is it focusing more on domestic demand, sustainable domestic demand and regional demand, which we think we can find in India and much of emerging ASEAN will be superior than what we will see in those highly tradable goods geared economies.
So as I said earlier, this is the point, Paul, and what is the one main message or point you want to leave with our viewers concerning the Asian economy or the economies in Asia right now?
As we see cyclical risks over the course of the next 1 to 2 years. Very near term, there's the possibility of there being a bounce in equities, but being driven by a possibility of a phase 1 trade war truce, if you like, and a stabilization in PMIs. But I think the main thing is that the cyclical risks are significant for equities as an asset class over the next 1 to 2 years.
Great. Thank you, Paul, and early happy Christmas to you. And thank you very much. That's the point for this week. Please follow us on Twitter, LinkedIn, and Facebook, and let's keep the dialogue going. Thank you.